Look, here's something interesting, because 2017 was a big cycle for assets, as we know.
Yeah. Yeah.
Does this speed of M2 make a difference or not? You know, it's like the question within the plumbing is what actually moves the dial in terms of the ultimate debasement, because this is a super accelerated easing of financial conditions going on that's driving M2 and driving the dollar. I don't know whether that's going to make it more powerful, different. I mean, it's hard to be more powerful than 2017, but that was early adoption phase in crypto. But well, I don't know. It just seems to be 2017 on steroids.
Recently, Bitcoin reached back-to-back all-time highs, first breaking above $116,000 and then soaring past $118,000. This breakout occurred alongside rising stablecoin reserves and a significant decline in retail inflows. Over the past 30 days, retail exchange deposits have fallen below $12 billion, indicating less selling pressure from smaller holders and a stronger presence from institutional investors. At the same time, the SSRAC, a liquidity indicator measuring the ratio of stablecoin supply to Bitcoin's market cap, has turned bullish, signaling fresh capital flowing into the ecosystem. This blend of expanding macro liquidity and increasing institutional demand has led many to draw parallels with the 2017 bull market, though this time the scale appears much larger. Real Vision CEO Raoul explains that today's market surge is driven by a supercharged easing of financial conditions, fueling rapid M2 growth and a global surge in dollar liquidity. While the setup may resemble 2017, everything is moving faster and on a much bigger scale. If this momentum continues, Raoul believes we could witness one of the most powerful and sustained bull runs in crypto history. Stay tuned until the end of the video, as Raoul and Real Vision's head of macro research, Julian Biddle, dive into what could be the most explosive phase yet for Bitcoin and digital assets.
What I have found is there's this nice phasing between financial conditions that lead everything and a hack for everybody who can't calculate financial conditions. We use a regression between the dollar, bond yields, and major industrial commodities. But actually, a piece of work that we just did recently that quite surprised us, gold is real-time financial conditions. Everyone's like, what drives gold? Suddenly we're like, we've seen this chart. Julie and I were like, something, and gold actually leads everything because it's actually current financial conditions, which kind of makes sense, right? It's the most sensitive to financial conditions. Then you've got the move in liquidity and markets, and the ISM kind of comes behind that. So there's this nice way that you can look at things to give you an understanding. So we all know, in fact, everybody on Twitter now knows that global M2 leads crypto by 3 fucking months. That chart will be the death of us, as we know.
You guys have created a cult.
And it'll fall apart at some point as well, and then we'll be the worst people in the world, even though we try and tell people. So we've got financial conditions, then we've got M2, then we've got markets, ISM. So there's a nice kind of understanding of where this goes, which allows you to forecast stuff because, again, there's one dominant factor, which is so easy. I remember before having to figure out all the variables of what was driving Brazilian rates, and nobody cares. It's like factor on, factor off. That's it. One game.
I think the point is what we've really tried to do is just simplify this all down. And so what Raoul's saying is right. Gold is, the inverse of financial conditions, largely because financial conditions are a function of the dollar. So you have that, then you've got global M2, which is 3 months behind that. Then 3 months behind that, you've got things like Bitcoin, tech stocks, and the yield curve, right? So actually, it's also a function of the yield curve. Then, you go back another, whatever it is. I mean, financial conditions lead the ISM by 9 months. And then at let's just say the ISM's at T equals 0. What people don't understand is that there's this flow of what we call the business cycle dominoes. So then, at minus 1 month, you're talking about things like hours, so growth in overtime hours. At minus 2 months, it's like capital goods orders, durable goods orders. At 3 months versus the ISM, as we know, it's something like GDP, industrial production. 4 months cyclical job growth, 5 months unemployment, 6 months CPI, and then you get into what I call the caboose of the business cycle train, which is things like wage growth and shelter inflation. And you've got these kind of domino sequences in inflation as well. Like commodity inflation leads to goods inflation, which leads to services inflation. It's just once you understand that, you can simplify everything down to say, okay, well, these are the things I really should be focused on when it comes to attempting to forecast the economic cycle to our
part of why
stability.
we kind of hubristically called it the everything code, because it kind of explains everything right now. And it's not to say that this code of the markets was always the code. It just is what it is. And it's, and it's all quite, well, relatively predictable. You're always going to make mistakes. You're going to fuck it up, all those things. But generally speaking, it's a very different environment than most people are used to.
Yeah. And I mean, if we just come to, because if you pull up that, you've probably seen this chart that we've shared a couple of times in the dollar. I mean, a big part of why, this year has, played out the way it has is because it looks a lot like it did back in 2017, right? When the dollar went up a lot in Q4, then it came lower, and we're seeing that accelerated, here this time around, which then, of course, given that the dollar rose in Q4 back in 2017, we get economic growth during the first half of 2017, which is kind of what we've seen this time around, right? We saw city economic surprises come lower, and this is a large part of why tech stocks and things like crypto corrected in Q1. But then in the back half of that year, given the extent to which financial conditions eased or have back then, but also, in Q1, set the stage for the SESI or the economic data to come in above consensus expectations. I mean, look at bond yields. See, people are going, and this is why actually we can talk about the cycle just for a second. Bond yields are really interesting because people are like, well, rates are too high. They are too high. And, the Fed knows this, everyone knows this. And this, for the everything code to be the everything code, they need to come lower. But what we said all along was that as long as rates don't go a lot higher from here and kind of remain range bound like they've done so far, this year and also back in 2017. In fact, in 2017, they started and ended the year at 2.5% or so, right? Because the major offset back then was that the dollar weakened as much as it did per this chart. Right. So there's points that
they were still doing well. They were kind of doing the balance sheet runoff in 2017.
Well, they were still hiking in 2017. They were still hiking rates. And then in the back half of that year, they did QT. All of the liquidity in 2017 came from the ECB and China, right? But net financial conditions eased because the dollar came lower. And then if you just look at these charts over the same time, I mean, global M2 has exploded, right? So it's like, it just feels eerily similar.
That's bizarrely good. That's a bizarrely good fit.
I mean, and I've just taken the same time period for all these charts. And so, a lot of what the Q1 weakness you saw, Felix, I'm sure you will have seen a lot of the big strategists coming out.
Felix, to go back to the question you raised before is, look, here's something interesting because 2017 was a big cycle for assets, as we know.
Yeah.
Does this speed of M2 make a difference or not? It's like the question within the plumbing is what actually moves the dial in terms of the ultimate debasement, because this is a super accelerated easing of financial conditions going on that's driving M2 and driving the dollar. I don't know whether that's going to make it more powerful, different. I mean, it's hard to be more powerful than 2017, but that was early adoption phase in crypto. But I don't know. But it just seems to be 2017 on steroids.
Back in 2017, the US dollar dropped sharply following a late 2016 rally, while global liquidity improved, mainly thanks to the European Central Bank and the People's Bank of China. Asset prices surged across the board, and crypto went parabolic. However, this rally was driven almost entirely by retail investors. Bitcoin and Ethereum were still emerging in the mainstream, and the infrastructure for digital assets was just beginning to take shape. Today, a similar setup is unfolding, but it's happening faster and on a much larger scale. Financial conditions are easing in real time, and Real Vision's Raoul Pal and Julian Bid highlight gold as the most reliable leading indicator. Their research shows that gold moves first, followed by M2 growth about 3 months later, then Bitcoin, tech stocks, and long-duration assets. This progression, which they call the business cycle dominoes, triggers the final phase of a liquidity-driven bull market. Our pal refers to this phase as the banana zone, the point where exponential adoption meets exponential liquidity, causing asset prices to break free from any traditional notion of fair value. It's in this zone that markets often shoot straight up, moving almost vertically.
When we come back to the idea that, markets and economies have become perfectly cyclical such that this extremely colorful, many people, can't even probably see the summer thing, but, these 4-year cycles and, things like liquidity cycles, obviously that then means you get 4-year cycles in crypto, and 4-year cycles in tech and just about everything else. And so the question is, okay, well, we're in the 3rd year of a 4-year traditional cycle. And you're going to say, and so if we look at those orange bars, be it fall, 2013 was a great year. 2017, that was the year Bitcoin did a 23x off the January lows. And you're like, all right, well, 2021, what was that? And that's what Raoul and I call, Bitcoin's truncated cycle. And that's, again, where we are today in 2025, but not truncated. Why? Well, because what happened in March of 2021? Liquidity, this is the net liquidity flow, peaked in March 2021 and went down in this straight line as basically everyone tapered liquidity flow, right? Guess what else peaked in March 2021? The business cycle, right? Whereas when we're looking at today, right, so liquidity's growth, like looking at a 12-month flows, basically just turned positive, right? Which is, you can say BOJ, ECB flow. And then the ISM is still, below 50. And then had we been sitting together, doing something like this back in March 2021, this is what we would have been looking at. So the ISM was at 63.8, and our forward-looking indicators were saying that the ISM was about to go down in pretty much a straight line. Well, this is where we were back then. Here's where we are today. I'm just going to do that one more time. Where we were back then and where we are today. So we're in a very different environment. This is basically suggesting that like Q2 of next year, the ISM gets to, let's call it the mid 50s. And so the point here is that because financial conditions have eased as much as they have, Felix, even with rates stable, dollars come down, which is the dominant factor in this index, at least, given the size of the move, it's actually extending, we believe it extends the business cycle outside of what a traditional 4-year cycle would be. And what we also know is that if this is right, and the ISM moves to, let's say, the mid 50s by, call it Q2 of next year, well, that once the ISM gets above 50, right, and then moves into its sort of late cycle peak, call it anywhere around 60, this tends to be where we get these really big moves in risk assets, and crypto included. It's also where we see alt season happen, right? Which is really what people are saying win banana. And the win banana, we're up 600%. The banana zone is not a 1 month get rich thing, right? It's, Bitcoin's up 600% since we said low in Q4 of 2022. That's, been a steady banana zone, but the question then is, when is the next leg? Well, we'll get the next leg as the ISM progresses towards 55, because the thing to think about this is just like a credit spread. Right? It's just like small cap versus large cap equities, which once you get into Bitcoin, which ETFs will be the large onboarding there, you got to think about that as like the way I think about that is like the gateway drug to crypto. So even if you're making, good money in Bitcoin, all of a sudden, if you're already orange pilled, right, and you're seeing something going up like Pepe or Bonk or Sui or Solana or whatever it is, you start to recycle those tokens very similar, like you'd be taking profit from a large cap growth equity at the bottom of the cycle and recycling it into small cap value and EM equities. Does that make sense?
Yeah,
and so
totally.
The economy's in a very different place, and the forward setup in terms of financial conditions looks good, but then also liquidity is rising. Okay, so here again, total liquidity, the 6-month flow is actually broken out of this kind of the range that we've been in, and that range that we've been in explains a lot of what has basically driven these knee-jerk reactions in crypto. The trend has been higher, but there's been, periods of time like the first half of last year, or even, the first quarter of this year, where basically we were just, kind of stuck in a range, which feels like that again now, but it's not the case, I don't believe. But so we still think here's as we call it, the most copied, chart in the world when it comes to Bitcoin. But I still think that the point with this, and Raoul and I have said this repeatedly, even though, you've got people on Twitter who are monitoring this tick for tick, it's not about that. It's about the direction of travel and the fact that the trend rate is still growing. And when you then look at the year-on-year comps, it's just kind of another way of thinking about this or looking at this. And I think that this very much paints the forward setup. So yeah, when you compare, as I say, the 2021 cycle versus the situation that we're in now, and we've both said that liquidity and the business cycle are the two most important drivers of risk assets, and that also applies to Bitcoin and the entire crypto universe, that these two elements are going to head higher over the next, let's say, 12 months, whatever. Into Q2 of next year.
And so, just using the liquidity framework, the business cycle framework, the financial conditions framework, it's all suggesting that the probability is, because they need to roll the debt, they're going to have to increase more liquidity, and this is just going to drive assets up strongly. And again, just so people understand why the business cycle matters for the ISM, if you think the ISM has been low, and then go and ask the average American running an average business in an average town, how are you feeling? They say pretty shit. Right? People's earnings haven't gone up. Your mortgages are too high, your car payments are too high, etc. So what happens is when the business cycle picks up, there's more disposable income and businesses have more investment income, and that gets driven at the risk curve always. That is what markets do. That is the game. And altcoins, as Julian said, are no different than junk bonds, no different to all the other stuff. It's all the same trade. So it feels like it's all to come for us. We don't see anything that suggests it's not going to happen. And we talked about before, the size of what's happening with global M2 and the dollar moves and stuff like that are very big. So no reason to expect that the move in asset prices is probably more than people expect. And I think the inverse to the business cycle being so low for so long will be the flip side of this cycle will be longer than people expected, because we've got this slight dislocation still working through post-COVID that then extends the business cycle. We don't know yet, but it feels like it's Q2 2024 so far. But if financial conditions keep moving, if they really have done some sort of Mar-a-Lago accord and they get the dollar below 90, okay, then we're going on further. Maybe it's a full bubble cycle then. Maybe we don't get who knows? But, one step at a time. But looks good.
Bitcoin has already surged more than 600% since its lows in 2022, but according to Raoul Pal and Julian Bid, we're still in the early stages. Liquidity is picking up, financial conditions are easing, and the ISM is expected to rise above 50, a level typically associated with the start of explosive moves in risk asset. However, the next big surge hasn't fully kicked in yet. With crypto adoption accelerating rapidly, Pal predicts a sharp increase in demand for block space and tokenized settlement as trading and tech giants dive deeper into Web3. If these trends continue, the crypto market could expand into a $100 trillion asset class. If that happens, what we're seeing now won't be the peak, it will feel more like the middle of the journey. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.